Hey everyone, welcome to this Sunday edition of the weekly market preview. This is from the Macro Shop. So here we are recording this on Sunday, February the 15th in the mid-afternoon. Okay, so let's immediately look and look at just a little bit what happened last week. We had two major data points. We had on Wednesday, unusually, we had the delayed non-farm payroll numbers, and then on Friday we had the CPI. I would say that in general, the market is taking from that a relatively positive takeaway, almost like a benign Goldilocks scenario. Now, why is that? That's because the non-farm payrolls, they came in pretty strongly, over 100,000. That was much higher than expectations. So the market came away with a lower unemployment rate, I think from memory down to 4.3%. So that's essentially saying that the US job economy, the job labor market is in a fairly strong state. Now, is that absolutely the case? I mean, it's interesting because you can look at charts like the following, which I just pulled up, which is the sector performance, and you can see here that, for example, if you're looking at the cumulative change in employment by sector in the US, you can see that really the vast majority of jobs which are being created are in the healthcare and the private education zones. Okay, now if you look at all of these other sectors, construction, utilities, financial, mining, logging, wholesale trade, retail trade, information, etc., basically all non-healthcare jobs, you can see that if anything, that's kind of declining or flat if you look at all the different individual sectors. So the point is that we do seem to be in the situation of equilibrium, where not a huge amount of jobs all across sectors are being created. But on the other hand, employers are not really feeling the need to fire people. And maybe that's just because the pool of available workers, there aren't that many immigrants coming into the US, documented or undocumented. So it does seem to be that the labor pool is relatively stagnant at this point. And that means that the unemployment rate is going down, and employers are saying, hey, we don't need to hire a lot of new people, but we're pretty happy with what we've got. So we just have this relatively stable employment situation. But as I say, if you look at graphs like this, it does give a slightly more nuanced picture that maybe the overall health of the US labor market is not wonderful, but it is merely reasonably solid. But hey, maybe reasonably solid is good because that will mean that the Fed doesn't have to hike anymore. And, why not, maybe it's going to cut. So that's that. Now, the second thing we got, of course, was the CPI. And the CPI, again, came in a relatively benign number. In fact, some of the metrics were a little bit lower than expected, 0.2, 0.3 month over month. And if you look at the overall yearly numbers, we're talking in the mid twos, 2.4, 2.5, which at this point is probably acceptable both for the Fed and also the White House, and possibly even incoming Fed Chair Kevin Warsh. So the point is a relatively Goldilocks kind of situation. And yet, and so the market's, relatively happy. But if you look at the indices, there's a lot of nervousness. And let's just look and just look at a couple of things here and see what's going on. And what I would say, I want to start by looking at some of the sectors because, well, actually, before we look at that, I just want to quickly look at the Fed pricing. And again, you can see here, if we're looking here just to take, for example, the April meeting, you can see that the current, which is this dark blue, this is where we are now for no change. And for one cut, you can see that compared to a week ago, this is now compared to a week ago, not really a huge amount of change. So let's say going in for one cut by April, probability now is 30.1%. So now is 26%, whereas it was 30.1%. So, a fraction of a hawkish repricing, not a huge amount. The market didn't really change that much at all. And if we look actually just looking at the SOFR, you can see what's more or less priced in is that the market at this point is, getting pretty comfortable saying, essentially you look here, one cut in middle of the year, one cut towards the end of the year in autumn. We're looking at about 50 basis points of cuts in total. That's kind of what the market is pricing in at the moment in terms of the Fed. So it doesn't really need to see, it doesn't really feel the need to get too much hawkish or too much more dovish. Where we are getting quite a lot of action and complexity, I would say, is what people like, under the hood, so to speak. So we can start looking at a few things. So let's just look at the volatility here. I just want to put this into perspective here. So if we look at volatility here, just want to show you this is the volatility from, let's say, for example, the 4th of February. This is the curve here, the VIX curve of all the futures. And you can see that on the 4th of February, just taking a random date of, sort of 8, 9, 10 days ago, you can see that is very much in an upward sloping, which is the sort of normal sort of shape of the volatility curve, the VIX curve, which is in a state of contango. So in the shorter term contracts, you can see that they're trading at lower prices than the further out contracts. And that's, in a simplistic way, that's essentially saying, hey, no reason for stress in the short term, but who knows what's going to happen in 4, 5, 6 months, each dot representing, as you can see, days to expiry for the VIX futures. But what's interesting, if you look at, I've put today, but it's actually on Friday, the last trading day, you can see how the shape of the curve in the VIX futures has actually gone a little bit sort of positive. So it's actually flipped from its normal sort of low stress contango state into a slightly backwardated state, which essentially means in simple English that the front of the curve is now in some cases getting sort of flat or even a little bit higher than some sort of dates further out. And what is that indicating? That's indicating that in the shorter term, the market is basically sort of pricing in a little bit more stress. And that is not great, because when we look at that curve sort of flipping into backwardation, and I'll show you something here. If we look at that flipping into backwardation, which I'm going to show you here, let's say we've got the another one here, which I'll just put up here. So this is the February minus the June contract, and you can see here that zero here. Zero basically means that a similar price. And normally, what you like to see, or what one normally sees, is sort of a negative value for VX1, VX2, the futures contracts, and that essentially is in that state of contango, which is basically saying that the market has relatively low stress. It's saying, hey, no need to panic in the short term. But what we're starting to see is a few little spikes. I mean, it's going up and down, but we're starting to see spikes above the zero level, which is a similar way of looking at what we just looked at, which is saying that the market is starting to price in here and there a little bit more volatility in the short term. And again, if we just look at the basic VIX index here, you can see that, over the last 4, 5, 6 trading days, we are getting these spikes. It's not anything crazy like we had, let's say, back in October or back in November, where we got into the high 20s, and we're certainly not in the 40s or 50s. But what we are starting to see is that VIX in general is spiking up, into the 20s, 18, 19, 20, and it's definitely not sort of settling around, very low levels of VIX at like 13, 14, or 15. So why is that? Why are we starting to get a little bit of sort of a nervousness creeping into the markets? And I think what we have to do is just to look at some of the narratives. If we actually just look at some of the sort of the indices, so we can look at, let's say, something like the ES, and you go, well, it's sort of more or less trading vaguely near its highs. We look at NASDAQ and whatnot down a little bit. But really what we have to do is just to look at this theme that maybe the market is starting to worry about AI, and there's definitely a huge amount of sector rotation going on. So the big theme here is, it seems, is we have to ask ourselves the question: is the market in a kind of a sell first, think later kind of mode? It's just sort of selling things, and what is it selling and what is it sort of not selling? And this is leading to a huge amount of sector dispersion. And that's why the indices are finding it hard to push to new all-time highs, whereas there's a lot of dispersion, which we'll look at in a second, of the different industries and the different sectors. So that's making, as I say, for a lot of sector dispersion, and traditional labels like, cyclicals versus defensives is not really what people are talking about anymore. They matter less. What we're really getting is almost like two baskets. It's like industries and sectors which are immune to AI, artificial intelligence, and we're getting sort of sectors, companies, industries which are going to be vulnerable to sort of AI and being. So we've moved on from this idea of the hyperscalers and capital expenditure and the build out of AI, and we know who the winners are there, and obviously the semiconductors and makers and like the chip makers and the makers of memory cards are doing very, very well. But it seems that in the last week or two, there's been this whole idea of disruption, this idea that certain industries are going to be extremely vulnerable to AI. So which ones are going to be safe? So we can say that the winners at the moment, considered to be relatively safe, is like maybe the commodity space, like physical commodities, industrials, which are going to benefit from the build out AI data centers and physical infrastructure, sort of the onshoring of US industry as well. So commodities, industrials, also healthcare, which is, pretty much a sort of a mainstay, no people still get sick. So healthcare are doing pretty well, and consumer staples doing very, very, very well. Now, which industries and sectors are considered maybe to be a little bit more exposed? We could start talking about sort of traditional media. Hey, if you've got all these sort of wonderful sort of AI apps, do you need the media anymore? Software, we've seen that there's been massive selling of, software as a service, SaaS kind of companies, which, like Adobe, even like parts of Microsoft. These kind of companies have been sold off a lot in the last week or two. We're also seeing financial services. We're seeing rollouts of sort of apps, AI apps, which can potentially, sort of make your tax more efficient, give you sort of, a portfolio and estate planning, and also logistics. We saw in the trucking, even like trucking logistics last 2 or 3 days selling off. So we're getting winners and losers. And what we need to do is to look here at maybe, just some of the sectors, have a quick look here and just have a look at the sectors. And it's very sort of stark. You can see who's the winners and losers. We've just got a bunch of moving averages here. So you can see here that the overall technology sector is trading on the heavy side. But whereas we can see, healthcare continues to trade around the highs, and that's considered a staple. You can see that financials is under pressure, and why is that? Is the idea here is that the AI, a lot of the AI innovations are basically going to sort of start taking the place of portfolio managers and estate planners and all this kind of thing. Now, if you look at then the consumer discretionary, that's also been trading heavy, and just compare that to XLP, which is the staples. I mean, like a crazy outperformance of consumer staples. So companies like Procter and Gamble are doing well. What was the other one? Johnson and Johnson. These kind of companies are doing super well. So staples super outperforming the sort of discretionary. You look at communication services under pressure, but then you look at industrials and you see, look at that, like a huge upturn. So, these physical things are doing well. And that's the same thing for energy. Look at energy stocks doing super well. XLE, if you look at utilities, doing super well. So the point is here that we're getting a lot of dispersion. And I just want to show you, I don't want to sort of belabor the point too much and flog a dead horse, but if I like to look at some of the ratios, I want to look at some of these sort of big factors which are going on. So if we look at let's have a look here. So let's look at SPY over SHY. No, actually not SHY. I wanted to look at, hold on, let me just bring up some of these. Okay, so if you look at, let's say, the QQQs versus the semiconductors, and you can see here that the general QQQs, like the NASDAQ, has absolutely massively sort of underperformed against the semiconductor ETF. So that's QQQ divided by SMH. Look at that massive outperformance, which continues to happen. Then if you look at, let's say, the QQQs versus the software, which is IGV, you can see that that's outperformed. So already you see that we've got, software underperforming, semiconductors outperforming, and the Qs, the general sort of tech index, somewhere in the middle. So you can see here, it's almost like you should be doing a butterfly spread. So, you essentially, you sort of long the QQQs, long the semiconductors, and shorting both of them like a double size. You're shorting the sort of the technology stocks. Sorry, not the technology, the software stocks. So very interesting to look at that. Then you say, what about the Mag 7? So we're talking, some of the hyperscalers, the Magnificent Seven, your Apples and your Amazons and your Metas and this. And what you can see here is that, for example, I've got the SMH. Now, the SMH, just to remind you, is the semiconductors. So if you look at the SMH to the MAGS ratio, again, you can see that the SMH is massively outperforming even the MAG 7. Now, then if you look at the SMH, which is the semiconductors, versus the IGV, you can see that that's also outperforming. So basically, you're getting this sort of hierarchy. And what could be interesting is let's say, for example, if we look at something like the MAGS, so let's just go for the MAGS and divide that by I don't know, you can look at, let's say, something like, what could we do? We could do sorry, not technology. We could do the software. Okay, so 2 relatively weak ones. But if we do that, we can then see that, in general, the MAGs have outperformed, although not in the last couple of days. And I'm actually just going to add that here. Just give me a second here, guys. Thank you for your patience. So the point is here that we have 4 or 5 different hierarchies, and it seems that at the top of the heap, in terms of the technology space, we have the semiconductors, and then we have maybe the general, let's call it the Qs, like the general technology sector. Then underperforming that, you have the Mag 7s, and then the laggard, absolutely at the bottom of the heap, is just the pure software plays. So this is what's happening. And that's why when we actually just go back to, if we go back to the broad indices, you can see here that, you see again that the QQQs, or let's say the Nasdaq, is sort of trading heavy and is quite choppy price action. Now you can see that in general that's underperforming, let's say the Nasdaq, sorry, the ES, which is also trading a little heavy. And then you can see that, for example, the Russell is actually not too badly. So again, if we just start looking at all the different sectors now, and we'll go back. So what I'm trying to say, we'll look at a few more different ratios to really get a sense of what's going on here. You can see that, for example, we can see the SPY in general is outperforming the technology sector, okay? But then if we look at SPY versus the Russell, you can see that in general, that's underperforming. So again, we're starting to see these hierarchies, not only within, let's say, the technology sector, but also on the index base. So it looks as though what's outperforming is the Russell, essentially. So again, you see the QQQs versus the IWM, which is the Russell ETF, of course, and that's the QQQs is underperforming. So if you start to look at all this stuff, you start going, okay, so it looks as though the Russell and equal weight is doing well. The SPY is kind of in the middle, is kind of balanced, and overall the tech sector is underperforming. And then, as we just saw, within the tech sector, there is a 4 or 5 level of sort of hierarchies. So very, very interesting to see what's going on there. Now, if we also look sort of on a global sense, we could say, well, okay, that's within the US sort of equity space, but what about global? And if we look at, some big picture things, we can see that, let's say, for example, first of all, looking at stocks versus bonds, if we look at the US space, so ITOT over government, and government is the ETF for general bonds, and ITOT is general stocks. You can see, it's starting to stall out a little bit, and we're starting to see that the stock market in general as an asset class is starting to roll over a little bit. You look at the moving averages here, it's starting to underperform sort of bonds just as an asset class here. And if you look at SPY versus TLT, for example, TLT obviously is like the 20 to 30-year bond, you can see this even more pronounced. So you're starting to see some outperformance of bonds here versus stocks in general. Okay, and what about US versus the rest of the world? And again, the pattern is this clear diversification going, some kind of 1, 2, 3% of asset allocators are definitely allocating money away from the US towards other markets. So if you look at something like SPY versus VEA, and VEA is essentially non-US developed markets. I mean, look at this. You can see here that the trend is very, very clearly for SPY underperformance versus rest of the world developed markets. Now, if we look at, let's say, Europe and Far East, and Asia, you can see the similar kind of thing, underperformance of the US stocks. Now, what about emerging markets? This has been a big theme, SPY versus EEM, ETF. Again, there's the occasional blip for a day or two, but essentially going, back for since the beginning of the year, you can see that the US stock market, there's definitely asset allocations happening within the US stock market indices, within the technology sector, within sectors themselves, and then within sort of geographic jurisdictions. And then if you look at SPY versus emerging market, excluding China, even more pronounced. So China, is not doing as well. So that's definitely what's sort of happening. And then if we go back and look at, let's say, some global equity, just to put this into context, just a few individual ones here. If we look at, let's say, Europe, we'll look at the Euro Stoxx at 600, which is like a broad index of Europe. You can see that is trading, more or less at the highs. And you compare that to the US stock indices, which we just looked at. So definitely outperformance, money going into Europe, even sort of some luxury brands, but we're seeing a lot of money going into defense stocks, especially in Germany. That's definitely sort of outperforming. And then if you look over in Japan, you can see the Nikkei, I mean, off for the last day or two a little bit, but essentially sort of doing very, very well. And we know what happened with the Prime Minister, Takaichi, fairly, more or less sort of stimulating the economy. We have a weak yen, which is going to be a positive for the Topix and the Nikkei and the Japanese ETF. So they're doing very, very well. And then if you look at a pure sort of commodities emerging market play like Brazil, I mean, this is just a very, very positive chart. And that just seems to continue to want to go up. And then, of course, if you look at other places in Asia, you can look at, let's say, the Kospi, which just in South Korea, which just continues to rip. Like, I don't know if it's parabolic. I mean, it's a fairly orderly, had a little bit of a sort of, a sort of sideways consolidation late November, and then, like a couple of weeks ago. And this is ripping high because this is essentially extremely highly correlated to something like the SOX or SMH index of semiconductors. And we all know that in Korea, you've got companies like SK Hynix, you've got Samsung, you've got, what is it called, SanDisk, for memory cards, which are in great demand. All of these sort of companies are really benefiting from sort of the hardware side of the AI story. And so the point is here that there's definitely sort of money flows are going out of the US. And it doesn't mean the US economy is going to collapse or the US stock market's going to collapse. It simply means, because I was reading of the weekend, a little bit of research about flows, and essentially all that's happening, if you've got like $100 billion fund and you say, hey, let's allocate another 1% to the rest of the world developed markets, that's going to cause these changes. So it's really sector rotation, geographic rotation, index rotation, and that's why the indices themselves in the US are fairly choppy. We're seeing the volatility, as I explained at the beginning, with the VIX going up a little bit. Okay. Whereas if you actually step back, as I say, and look at the data, it seems as though inflation is not doing too badly, and the US labor market, is sort of doing okay without doing brilliantly well. So that's definitely what we need to be looking at, this week, because as I say, we don't have a huge amount of earnings. What we do have a few different earnings, but not a huge amount. Some of the things I'll be looking at, not so much in the next day or two, but I think it could be kind of interesting to be looking at Walmart, for example, on Thursday. That's going to give us a bit of a sense about the US consumer, pretty much the mass consumer. There could be some talk also about tariffs, is Walmart eating the tariffs? And also just in terms of sort of equipment. John Deere is always interested just in terms of infrastructure and equipment, farming equipment. And then Wayfair, the big sort of furniture mass retailer, that along with sort of Walmart will give us a little bit of a read also just on the state of the US consumer. So, not a huge amount of earnings, but a couple of interesting ones. And other sectors to be looking at, it was just interesting looking at like something like energy. And we can look at, where's my energy? So if you look at something like oil field services, OIH, that just continues to rip. And I just want to gently, it's like a bit of a trading thing here. We can see this green line. This is basically when Trump did the whole Maduro in Venezuela. Remember a few weeks ago, and extracted Maduro. And there was this idea that there'd be a lot more sort of oil infrastructure spending maybe in Venezuela. Just interesting to see that market for oil services has continued to push higher, which is benefiting companies like Halliburton, Schlumberger also doing pretty well. Actually, Baker Hughes as well doing very, very well. So the point I'm trying to make here is that rather than playing the indices, it's individual industries, which are sort of specific stories and obviously sectors. And that's really what, we all need to be focusing on this week. Okay, so if we look at a few other different things, let's just look at, I just want to look at the bonds now. So let's just look at the bonds. Quite interesting what happened here. So if we just look overall, actually, we'll look at the yields. Let's just go to the US yields. So if we look at the yields, what's happening in general, when we did get a pop, on the Wednesday, you can see this pop on the Wednesday, which is for the non-farm payrolls, the strong non-farm payrolls, average hourly earnings a little higher than expected. But very, very quickly, the market recovered. And you can see that in general, the 2-year yield, which is sort of a proxy for, well, not exactly a proxy for where the Fed is, that's more the SOFRs, but let's say sort of a year or two out, you can see that the tendency is for the yields to go down. And if we now look at the 5-year, you can see that rip down a lot lower, and then the 10-year yield and the 30-year yield. So it's interesting. There's been a lot of the yields really sort of coming down lower, and that to me is quite interesting because, as I say, if you look at the general economy, it seems to be doing quite well. Earnings seems to be doing quite well, but it is indicative of a couple of things. And what could that be? First of all, I'll get onto the curve because there's quite a lot of nuance in the curve here, but let's just look at a couple of things here. And so if you look here at the break-evens, which is kind of like a proxy of inflation rates as measured by the bond market, you can see here that the market is essentially saying, hey, inflation is maybe going away as a really first order problem. in theory. I don't know if that's the case, but that's kind of what the market is saying. So maybe that's a positive for the bond yields. I don't know necessarily, as we saw earlier, it's not as though the market is saying that the Fed is going to be sort of cutting super aggressively, but it could be a combination of things of saying, hey, the inflation rate seems to be kind of stabilizing. We do have a new Fed chair who, at the end of the day is going to be a relatively political animal, Kevin Walsh. There's going to be a huge amount of pressure from the Trump administration to cut, obviously. And also looking at the job market, as we saw in that earlier graph I showed you, for sure the job market is stable and the unemployment rate is going down, but is it going to stay that way? And if we have more and more jitters and concerns about potential disruptions from the artificial intelligence sort of revolution, essentially, there could be more concerns about employment and layoffs to come. And we're starting to see these announcements of layoffs, 5,000 here, 1,000 here, Amazon here, UPS here. There are companies definitely starting to cut workers, and some of it could be AI. So I just wonder whether something like the break evens and the bond yields going down is starting to sort of say, it's not all rosy. Now, what is also interesting, though, to look at these bond yields is that it's quite a nuanced story, and I want to look through some of the curves. So, did we get a flattening on the 2s to 5s? Yes, we did. So we had the 5-year yield coming down a lot more. That's what it's basically saying, the 5-year yield. Now, the 5-year yield, you should take that as a proxy, not specifically as, exactly 5 years from now, 2031, but sort of like medium term. And this is telling you that the market is basically saying, hey, medium term, we're not necessarily saying that, the economy is going to be super hot. And maybe we should be parking some money in this 5-year tenor. Because what's interesting is that if you look at, let's say, something like the 2s, 10s, okay, that's also flattening. And if you look at, let's say, something like the 2s, 30s, you can see some flattening, although a bit of steepening here on Friday, okay? But what's very interesting is if you start looking at a couple of other different things. So let's, for example, now look at the 5s, 10s. So this is kind of like the medium term going out to longer term. And what you can see here is that we actually got a little bit of steepening. And then if you look at something like the 5s, 30s, you can see a little bit more steepening. And then if you look at the 10s, 30s, you can start to see a little bit more steepening. So what is that telling you? That is telling you that there's kind of a bit of nuance going on between the 2-year, the shorter term ones, let's say the belly of the curve, the 5, 7, 8-year kind of bonds, and let's say like the longer term 10s and 30s. And I personally think that the market is saying the following, and I'm just going to bring up a butterfly here, which essentially, shows this pretty well. So I'm going to just show the butterfly here of the, if I can find it, of the, did I have the 2s, 5s, and 10s? Well, you can look at the 2s, 5s, and 10s here, or did I have the 2s, 5s, and 30s? Let's have a look here. Well, we look at the 2s, 5s, and 30s, and what you can see here is that this is essentially, this butterfly chart is essentially, long, a 2-year yield, and a 10-year yield, and short the 5-year and a yield. And essentially what this is saying here is that the 5-year yield has gone down the most because you're shorting it. So it's kind of a bit counterintuitive. But essentially what they're saying is that the 5-year yield has performed best in the sense that it's gone down the most compared to the wings, the 2-year and the 30-year yield. Okay, so all of the yields, as we saw earlier, have gone down, but essentially the money flow is going into the belly of the curve. And I think that's because the market is saying, hey, we're still a bit worried about Fed independence, too much issuance, the deficit, long-term bonds. Is that going to be a problem? And I think on the 2-year, it's saying that, hey, maybe the Fed's not going to cut a huge amount. We're pricing in 2 cuts. So it's just interesting to see here that really the market which performed the best here was the and again you see here the 2s, 5s, and the 30s. You can see here that the 5-year yield here actually sort of outperformed the 2s and the 30s. Not only the 2s, 5s, and 10s, but the 2s, 5s, and 30s. The butterfly really outperformed. So that's kind of interesting to see what's going on there. I think the market is a bit concerned about the immediate situation and the 30-year yield. And as I said, that money flow is going into like the 5s and the 7s. The other thing which I wanted to have a look at, we'll get onto sort of FX now, is actually if you look at real yields. So grabbing some water. If we look at the real yields here, let's just see. So we have here like the 10-year yield subtracting the break-evens for inflation, and you get really what the real yield is after inflation. And again, what you can see here is that the real yields are going down. This indicates, that the nominal yields are sort of relatively stable. They were going down a little bit, but basically the break-evens, as we saw, the inflation rate going down a lot more, and that's essentially saying that the real rate of return, as you guys can see here, is actually going down more. Now, why is that important? That's also important for sort of for FX. So if we look at, let's say, some of the differentials, if we look here at, I want to look here at some differentials. So let's say US 2-year versus Germany 2-year. You can see here the differentials are closing in, are narrowing. So basically, the German 2-year yield is getting closer to its US counterpart, right? Now, that should be a net negative for the US dollar and a net positive, let's say, for the euro. Similar thing on the 5s. You can see here those differentials coming in. You can also see the differentials on the 10s coming in big time and on the 30s coming in a lot. So what we have is a situation here, if we now start looking at some of the FX charts, let's just bring up the dollar, the dollar index. You can see here that the differentials are narrowing. Now, ordinarily, in theory, that should be a negative for the US dollar. We also see that the US real yields are actually sort of getting less as well. So that's putting downward pressure on the US dollar. And we've seen that, that the US dollar, or the Dixie index, did fail at the 61.8% fib retracement about 98, about sort of 6 or 7 trading days ago. And we can see that subsequent to that, it's sort of come off a little bit. But what's interesting is that, I mean, in theory, this should be trading a little bit heavier, but you can see that it's sort of, done nothing much for a few days. It's trading sideways. And I just wonder whether the market is caught between, lower real yields and narrowing differentials on one hand, which is negative for the US dollar, but on the other hand, it's looking at the economic data and earnings and the employment market and saying, hey, not too bad. And also, does the Fed really need to be cutting super aggressively when you have, unemployment rate going down, non-farm payrolls looking, potentially not too bad, and in inflation coming down? Well, that would be an argument potentially to cut. So it's interesting to see. Let's see what happens to the dollar this week, and of course that's going to be reflected in something like the euro. You can see that the euro here had been strengthening a little bit, but just sort of falling away a little bit. In terms of some of the other currencies, interesting to see that Japan here is now at the 200-day EMA. So the Japanese yen has been very strong. So we see a weak US dollar here, USD JPY. We also at the bottom of a downtrend line. So this is going to be interesting here to see whether this starts to sort of puke and break this pretty key level at around about 152.25 or so. That would be the 200-day EMA. Also, as you can see, this sort of downtrend support here. If that were to break, there's definitely more downside. But is it going to depend on the data? Now, talking of the data, in terms of the US, we don't get a huge amount. We get Empire. What else do we get? We get the FOMC minutes on Wednesday afternoon. That could be interesting just in terms of giving us more information about the Fed, the balance sheet. On Wednesday morning, we do get durable goods, not bad. That's kind of interesting. We get initial jobless claims. But what could actually be the most important could be on Friday, we get the fourth quarter of 2025, first reading of the GDP with the PCE numbers, the core PCE, personal spending, personal income, and we get the flash S&P Global PMIs on Friday. So there is some data, but it's a bit more sort of towards the back of the week. And of course, tomorrow the cash markets are closed. And the futures markets only have a half day because of a President's Day. So it's kind of like a holiday tomorrow in the States. Talking about holidays, we also in China, we have the Lunar New Year in Asia and in China. So all of the Chinese markets are closed all of this week. So Asia could be a little more sort of relaxed. But just talking about the USD JPY, what could get the market's attention on Thursday evening is the Japanese CPI and PMIs at about sort of 6:30 and 7:30 p.m. our time. But so it's going to be interesting to see what happens there. In terms of some other stuff, the Australian dollar, it is coming off a little bit. It's been on a bit of a hot run. We do have RBA minutes tomorrow, so that's Monday evening. That's going to be interesting in terms of their outlook for the general economy, but also on inflation. We know that both the governor and the deputy governor recently have voiced concerns about the path of inflation. So it's going to be interesting to see if that's reflected in the RBA minutes tomorrow evening. We also get Australian employment on Wednesday. So I think, this could fiddle around tomorrow a little bit. and will obviously be US dollar dependent. But once we get those RBA minutes and also the employment numbers on Wednesday, that could give a bit more directionality to the Aussie dollar. If we go across to the New Zealand dollar, we do have the Reserve Bank of New Zealand tomorrow. I'll talk about that. Sorry, on Tuesday, my mistake, I beg your pardon. On Tuesday evening, we have that. So I'll talk about that more on Tuesday morning's video. But interesting to see that's just kind of consolidating as well. So, the FX space seems to be relatively calm. What is interesting is just to go and have a quick look, as I was saying, at the emerging market FX, because that is where you've been seeing really a huge amount of strength in the emerging markets. And you can see, for example, against the South African rand, in general, the US dollar has been extremely weak. You see against the Brazilian real, a bit choppy, but still pretty weak. And if you look against the, actually, I want to look at the Mexican peso, you can just see how weak the US dollar has been. So what's interesting is that, we have the tendency often, well, unless you're an EMFX trader, just to look at the G7 currencies, where the US dollar is, has been weakening, but then it had a bounce and now it's consolidating. If you look at the US dollar against a basket of emerging markets, it's been extremely weak. Okay, and so that's very good for local currency bonds and US denominated bonds for emerging market and emerging market stocks in general. And that's been one of those big pushes. So keep your eye on some of these other cross pairs, like the US dollar versus, especially I'd say the peso, the South African rand, Brazilian real are pretty good ones to look at. So that's interesting there. Other thing I want to keep an eye on here, let's have a look at a couple of other things here. Want to look at BTC and some of the metals. Not a huge amount to say about the metals. My personal view here is that the macro for gold remains relatively constructive. The volatility is elevated, but definitely sort of coming down on gold volatility. Same for silver. My personal view here, you see here at the 61.8 Fib retrace, that did fail. At this point, we had a little bit of a bounce on Friday with the relatively benign CPI. Personally, I think gold probably needs just to calm down a little bit and then could grind higher. But I think we might just want to see this grind sideways for a few days. And again, with the Chinese buyers, more or less on holiday for a week, I think we could expect that to grind high. I personally won't be participating until we get a little bit more of an attractive sort of entry price, maybe, somewhere down about, 4,600 or something like that. And then in terms of silver, if we look at the silver spot, similar kind of situation, generally after you have a huge amount of volatility like that, it does require a little bit of a shakeout and a little bit of sideways consolidation. So I would expect this just to sideways consolidate a little bit. And for sure, if silver gets a little bit lower at something like 71.5, that does start to become quite an attractive risk reward sort of structure. Copper, again, the Chinese market, as I just mentioned, it's got to be on not on sale, on holiday for a week with the Lunar New Year. Again, just sort of a bit of a sideways choppy action. This doesn't look too exciting. I did see over the weekend the inventories at a lot of the exchanges around the world, and the level of inventories is going a lot higher. That is not supportive in the short term for copper. We all know the bullish medium to long term narrative, but in the short term, inventories have gone have risen substantially in Shanghai, London, and the New York sort of futures exchanges, warehouses there. So copper just kind of in a bit of a sideways chop. BTC remains weak. We had a little bit of a bounce, I guess you could call it. But again, even if you look at this impulse, as I say, we still haven't got above that recent high at 72,180, which is the 38% Fib retrace. So unless we start to chew through some of these Fib levels, this is still distributive and weak price action. Simple as that. And we do need probably a new narrative. Now, in terms of just some other things, I think that's about it. Oh, just quickly wanted to have a quick look at oil. Now, the oil, what's kind of interesting, I just want to look at some of the time spreads here, which possibly it'd be better to look at energy. So if I look at the future in oil, so if we look at oil, we can see here on the CL1 contract, so the front contract here, again, just chopping around in a range. What is interesting is that it does seem to have found there's definitely sort of buyers at around the 62.30 on the front contract. In terms of the geopolitics, We know that what do we know? We know that there's, I mean, it's balanced. There's sort of negative and positive comments coming out of Trump and Israel and the Iranians. We want a deal, but a limited deal, and the Iranians want this. I'm not going to go into all the details. Maybe tomorrow I'll go into a bit more details. But there is still the possibility of military action, which obviously is a positive for the oil price. On the other hand, Trump doesn't want higher oil prices, and there's a possibility of some kind of compromise deal, or maybe it's just going to be really messy. We'll have to see. But it does seem as though oil is comfortable at this point, trading within this range. I was doing some research again over the weekend. Definitely the Chinese have been buying at low levels. They have surreptitiously been increasing their inventories very, very substantially over the last, 1, 3, 5, 10 years. Is this a harbinger of a military action? Definitely the Chinese, any kind of dip in prices, they have been buying in secret a lot of oil. And some people say that's been one of the reasons that why the oil price has been supported, because it seems to be sort of constant and continuous Chinese demand whenever the price dips to sort of top up their strategic petroleum reserves. So that's interesting. But if we look at a few time spreads, let's just look at a few time spreads. You see CL1, CL2, not great. If we look at CL1 to June, also sort of trading pretty much on the heavy side, so that's not a positive. If you look at CL1, so the front contract out to December, also trading pretty much on the heavy side. So the point is here that the time spreads, and if we look a bit further out, which the industry likes to trade, so December 26 to December 27, also in the last few days trading sort of, heavy or slash in a range. So oil at this point is looking for a little bit of direction. We have the DOE numbers, we have API this week, and we have the DOE numbers released on Thursday at midday rather than the traditional Wednesday because of tomorrow's holiday. So I think at this point, oil, it's a question of buying it at the dip, at the lows of that, just establishing that trading range and dipping your toe in if it does dip. To use a bit of a double pun there. Okay, guys, so I'm going to leave it there. That's about it for today. As I say, I think this week there's a little bit of data. Let's keep an eye on any of the headlines. And I think really it's going to be about looking at within the tech space, all of those rotations and the single sectors within the S&P space. And then on a broader picture, it's going to be sort of looking between, let's say, the US versus developed market, US versus sort of emerging markets and so on, like all of these thematic plays, rather than, let's say, the stock indices as such. I'm going to leave it there for the weekly sort of market review. I can check it out at the Macro Shop. And I'll be back maybe tomorrow, maybe not with a quick one, because it's technically sort of a semi-holiday. The cash equity market is on holidays in the US and, of course, China for the Lunar New Year. But if not tomorrow, definitely on Tuesday, the 17th in the morning for the normal macro snapshot. Hope that was useful. Have a great Sunday afternoon. Thank you.